we flogged certain concerns on excessive growth in the unsecured retail loan and over-reliance of NBFCs on bank funding. Recent data suggests there has been some moderation on these loans and advances. We are closely monitoring the incoming data to ascertain if further measures are necessary. Sounds serious. The boards and the top management of regulated entities should ensure that risk limits and exposures of each line of business are kept well within their respective risk appetite framework. The persisting gap between credit and deposit growth rates warrants a rethink by the boards of banks to re-strategize their business plans. A prudent balance between assets and liabilities has to be maintained. Mr. Sethi, first to you, does this sound like a warning that more may come?
I don't see as a warning. In fact, the risk weights which have been readjusted in the last policy announcements has indeed, moderated the unsecured loan rate growth in the system. Some banks might have continued the same growth rate, but I think usually we see that the unsecured loan portfolio seems to have been moderated in the growth. But the concern on the deposit growth lagging behind credit growth, I think, is voiced formally, informally by the central bank. I'm sure all of us definitely work on how do we address this issue. It is not to discourage credit growth. I don't read it as a discouraging the credit growth. Obviously, the credit growth is a function of what economy is going to perform. Macros are doing well, and if you have a GDP growth rate of 7.2, and the ballpark estimate is that the credit growth normally is, at least in the corporate side, would be twice the GDP growth rate, which means 14 to 15% credit growth rates will continue. So now we need to look at how do we strengthen our deposit mobilization. Hopefully without readjusting the rates too much, so that the margins are not under pressure. I think it is more in terms of cautioning that we have to double up on the retail deposit mobilization. That is my reading.
Okay. So, if anything, the pressure on margins could be there, you think, Mr. Sethi?
So, we'll see. I think while the banks have to look at their asset liability mismatches, and if these mismatches are growing, they may have to focus on liabilities. And as I continue to say that every one of the major banks will be focusing on their reach, their marketing, strengthening to raise the deposits without increasing the rates insignificantly. I think the readjustment and various tenors keep happening. Even SBI has done some readjustment in the tenor-based pricing on the deposits. But I think broadly we all will be working in terms of focusing how we reach out to the customers and mobilize the deposits. And also, as I think Rajiv was mentioning, the government spending would definitely increase the liquidity, and some of the liquidity definitely would come back to the banks in terms of the deposits. So there will be some easing of pressure on the deposit side.
Okay. Let me get, thank you very much, Mr. Sethi, for that. Rajiv, your thoughts? I mean, we are closely monitoring the incoming data to ascertain if further measures are necessary. Will you take it as business as usual statement?
So I think this conversation between RBI and regulated entities on LDR and unsecured lending is not new. And if you see data of banks of the previous quarter, as Mr. Sethi mentioned, we have seen unsecured lending has slowed, as also LDRs have improved. For some banks a little more, some banks a little less. And I can assure you that both these issues have the attention of the senior management and boards at most large banks, and we continue to do whatever it takes to ensure that we are raising deposits, whether it is current or savings or retail term deposits, as the case may be. But I also want to importantly point out here is that as banks, we are not only looking at LDR but also the quality of deposits, through improving outflow rates, etc., which is through the LCR mechanism.
Okay, just overall, Rajiv, would you say that there is any pressure on margin at all, even by 1 or 2 basis points, from what the governor is saying, the need to concentrate on deposits?
Lata, I think banks have multiple levers to manage margins. I think the point is that if you see the large repricing of deposits, because of the fact that short-end rates went up quite sharply, I think that is pretty much done. And on the asset side, pricing pressure has somewhat reduced, and banks are also looking to optimize between NIMs and growth, and so therefore you will see that margins will be maintained as we go forward.
Okay. All right. Thank you very much, Mr. Sethi, Rajiv, Mr. Ashwini Kumar, Upasna, Kaushik. Am I leaving out anyone? Shobit. Thank you very much. Shobit, just before you go, the yields have come up to 7.02. They were 7.018. I mean, it's not a big change, but why is the bond market suddenly a little worried?
Lata, I think it could be a function of the auction. We have the 10-year benchmark auction scheduled for today.
All right.
So traders might be just creating some room to bid in the auction. So I would not read too much into, few basis point movement.
Fair enough. Fair enough. Fair enough. Well, as you said, at the moment, the bond markets are very rightly focused on Delhi and not on Mint Street because it is the budget and the nature of the deficit that will be their prime concern. Gentlemen and Upasna, thank you very much indeed for parsing the Reserve Bank Governor's statement this morning. I think the Governor has introduced a bit of drama, definitely for the stock markets. The growth estimate has been upped, and that was not anyone's base case. It was not mentioned in the poll. Some of them did mention it last week when Ritu was doing the poll, but this week after the elections, people were, if anything, wondering whether there will be a downward bias to their own growth forecast. The Reserve Bank Governor coming in boldly increasing it by 20 basis points from an already high 7%. 7% is above the median expectation on the street. There are only 2 forecasts about the Governor that I know, SBI and Citi. So the Governor bringing it up to 7.2 is a very big boost to the stock markets, and we see that 1% rally and the Nifty going up to 23,000 plus. The other positive is that 2 members are now voting against the status quo policy. 2 members want shift to of the stance from withdrawal of accommodation to probably neutral and a cut in the policy rates. That gives some kind of a dovish bias to the entire policy. It means you can't negate, you can't avoid this expectation from 2 of the external members for very long. So probably is there a rate cut somewhere in the horizon, or at least is there a stance change as early as August, is something that the government, that the bond markets will start mulling over. At the moment they are preoccupied with Delhi, but they will start mulling over a stance change as we come closer to the August policy. Ritu, thank you very much for joining in this conversation. We end our special coverage of the monetary policy. It's back to the stock markets where there is a lot of drama. That's after a short break.
unsecured lending book that is.
One more thing Governor Sir talked about was the customer convenience, giving them e-Nuts mandate facility for various additional products also. I think that will improve the customer convenience and stickiness of the customer with the bank.
Okay. Thanks for that, Mr. Ashwini Kumar. I just want to ask the bankers another question on the way the governor has voiced concern on the credit deposit, growth difference. I don't know, to me it sounds like almost reading the Riot Act, but maybe I'm exaggerating. Let me read the paragraph again. In November.
Good morning. Welcome to the CNBC TV 18 HDFC Sky Election Headquarters. You're watching Trading Hour. I'm Reema Tendulkar.
Recent data suggests there has been some moderation on these loans and advances.
And Surabhi,
we are closely monitoring the incoming data.
23,000 has been scaled. It's a 1 percentage point plus gain on the benchmark indices for the week so far. And this is a big week, the election week, and the benchmark indices scaled a 2.5% return. And now I think we're going to start that countdown once again to our all-time high levels. 23,338 was the all-time high level of the Nifty, and we're just about 250 points away from balance between assets and liabilities. 1.1%
be maintained.
Not too far with the way it's moving up.
That would be quite something. I mean, to end this week at a fresh all-time high would be a statement. But just to take away from what the RBI has done, I mean, frankly, we'll ask our experts, market experts, this, but the policy didn't have anything specifically dovish. Nothing has changed. Rates haven't changed. The stance hasn't changed. Yes, the outlook on GDP growth has been revised higher. 7% becomes now 7.2% for FY25. The inflation forecast is unchanged at 4.5%. So not much, if anything, actually. There was a sense of hawkishness, not on monetary policy, but on unsecured lending, with the RBI saying that the central bank is watching the incoming data very, very carefully, monitoring this data. And he acknowledged the fact that there has been some reduction in unsecured lending, and he said that more actions could be taken if warranted, depending on incoming data on unsecured loans. So if anything, it was slightly on the edge, so to speak. And of course, there was some mention of improving governance standards as well. He spoke about how regulated entities, are still not disclosing all the information in the key fact statement which comes with a loan. So at the margin, I mean, there's no talk of any major bazooka from the RBI, at least not in terms of that language. But it seems that the market is moving on its own terms. And I think, Reema, it's more about the overall sentiment, sort of moving away from the slam dunk of Tuesday and perhaps starting to get a little hopeful and positive as we're looking at government formation, as we're looking at the allocation of the all-important portfodios. And maybe this is positioning, with the assumption that there will still be policy, continuity, and there won't be too many knee-jerk changes in terms of, what Modi 3.0 will deliver, because this is a green-looking screen. Banks were underperforming, they still are, but they've kind of caught up. But yeah, the Nifty and the mid-cap index looking very good with that 1%.
As one of the guests had said, that we may not see big bang reforms, but policy continuity should definitely be there in the next 5 months, and that perhaps is enough, even if we don't get, big reforms. But I think the surprise winner of this week has been IT.
Oh yes.
The first half of the week was all about FMCG and the comeback of consumption spending, rural demand. But IT has now been the best performing sectoral index. Today it's up 3%, and this week it's seen a gain of 8.2%. And IT at current levels is the best performing sectoral index, followed by FMCG, which is up 6.1%. So this whole Nasdaq rally, Nvidia move may have had a rub-off impact on the Indian IT stocks. But let's begin Trading Hour by focusing on the markets following RBI's decision. We invite Ajay Srivastava, CEO of Dimensions Corporate Finance Services, to take a few questions. Ajay, morning. What do we start with? The way the markets have been whipsawed and now firmly up post the budget, the slam dunk on Tuesday, now the RBI policy. Take us through your market construct at this level. What have you made of the action, and how would you approach it?
I think it's been Reema, it's the best wake-up call investors could have had, because it was becoming so easy, the dartboard approach, buy what you want. And I think that one-day correction brought in a lot of reality to the market that things can happen. And when they happen with a vengeance. And which also tell you the Indian market is today sitting on a lot of leverage positions, because what happened that day was clearly leverage positions getting cut left, right, and center at market. So therefore, one should be cognizant that if one is investing at these rates, nothing wrong with, economy will continue. But what we came away take out, I don't think the RBI Credit Policy Committee has understood the mandate of the people. The people's mandate was against inflation, really. It hurt everybody and the common man more and more. And what I heard today is that inflation is not going to come down as per RBI policy at 4.8%, but there is a move by external members to say rate cut. That's not good news. RBI needs to be really focused on inflation reduction, and if it doesn't happen, this long-term rallies do fizzle out in the end because inflation rears an ugly head and the political realities will start to catch up. Therefore, I think we are at this level, most of us are invested well into the market. We don't think there's a need to take further position in this market. If you got cash, at least 20% cash, hold on to it. And, and just wait it out, because I can see very clearly our analysts are telling us the leverage positions are getting built up rapidly again. And that is what happened 3 days back, can happen anytime. So keep some cash handy. People who had cash on that date reaped a good dividend. If you didn't have cash or leverage and you were cut, you know what happened next morning. You were really very, very poor. So I would say, recommend very clearly is, I think, hold your positions today. Do not try to invest beyond 23,000 kind of indexes at this point of time. Let's wait for the budget. Let's see where it goes. Let the formation come through. There'll be enough time to invest, and FOMO is dead, as you all know.
And that's exactly what this market has been made of. FOMO, right? FOMO that's making people buy stocks at 80 times, 90 times and what have you. By the way, 11 o'clock is also the NDA meeting. I think it's taking place in the Parliament Hall, where all the allies are coming together and then they'll discuss sort of the next steps, and we'll get you more on that as we go along. But Ajay, hi, it's great to have you with us.
Thank you.
How do you navigate a market like this? You have a big event, you have a bit of a shakeout. It lasts for one day, and now you're talking virtual all-time highs again. And this happening when FIIs are still selling, and that's my only concern, and I want your perspective on this, because that's a massive wall of selling that is still hitting us on a daily basis. And yesterday, domestic institutions didn't absorb all the selling, so it's very clear that retail and HNI is also buying. I don't know, does it make you feel nervous? How do you look at this?
I think the best people were who were away on a holiday on the election day, of, if you ask me, result day. Those guys, they came out the best because they didn't have to take a call either ways. So, that's why I said, in this market, one has to be careful, to cognizant of the fact that you got to take some money off the table. You got to be clearly invested in certain stocks, and over leveraging in this market is going to be a disaster, if you ask me. Definitely a disaster. So if you are out of the market and you want to now buy futures and options, I think that's not a smart idea to be. It doesn't matter. At the end of the day, the fundamentals count. At the end of the day, P's count. At the end of the day, realities come into play. And we cannot be not aware that now we have a government which has to respond to two key issues in the economy, which is inflation and income diversity. That has to be acknowledged, is thing on the table. And if we thought it's going to be business as usual, I think they'll be fairly disappointed in the next 12 months to see that the government has now, whether it is a positive or negative stock market, I don't know. But I know for sure is not going to be the business as last year, because two issues on the table: inflation, which RBI did not address today, it kept it at 4.8%, and income divergence, the divergence of